So there are just a couple more items with inventory that I want to draw your attention to. Chapter 9 is full of a few more that you shouldn't ignore. You're going to have to understand them eventually for the CPA exam, and also some finer details with LIFO. But I know I'm filling you up with a lot of stuff for this exam, so I sort of cut it off at just covering two more items. One is the lower of cost or market, and the other one will be inventory errors. So we talked about inventory having a lower cost of market valuation. And the idea is that when the future value or the value of inventory drops below its historical cost, or the cost we either pay to acquire it or the cost we pay to manufacture the inventory, we abandon the historical cost principle and recognize the loss when we are aware of it. Again, this is following conservatism. Abandoning the historical cost principle only occurs when we have a fair market value for our inventory that is less than its cost. If we have a greater market value than cost, we don't recognize an increase in the value of our cost of inventory, so we only do this downward. Why would it decline? We could quote obsolescence, which means that demand has decreased due to new product lines that compete, and therefore our inventory has become obsolete in some regard. Perhaps there's been physical deterioration of the employee, or just a change in the consumer tastes, which drives the demand down, and consequently the price of the inventory would go down. When we apply the cost of market rule, it's become a lot more simple over the years. We used to have a lot of different items for inventory, a lot of different potential fair market value costs for inventory, and now we just recognize one. The real cost of the inventory that we're going to look at is the net realizable value. And the net realizable value is going to be determined by looking at the sale price and subtracting off the completion or disposal cost. This is the absolute maximum we can expect to receive for the inventory, because what we're talking about then is the price that we're going to be selling it at, and then the price that it's going to take in order to sell it. If we marked the inventory any higher than this, we would have negative gross profit because we wouldn't be able to move the inventory without taking a hit over our costs. So the inventory's value is going to be either going to be the cost or the net realizable value. The estimated selling price is given to you for a number of goods in a company, and then the cost to sell here as well. The normal profit margin is inconsequential in this case. It's something that was in effect prior to certain changes in FASB. And so all you need to do is compare the estimated selling price less the cost to sell versus the cost itself. So what is the net realizable value of number one? It would be 120 minus 0. And the cost would be 100. So now we take the lower of the two, which in this case is the cost. In the second one, we have estimated selling price of 120, a cost to complete or sell of 5. And so it gives me a net realizable value of 115. And again, we want to take the cost because it's the lower of the two. In this case, we have an estimated selling price of 110 and cost to sell of 20. So that brings it down to 90, which is less than cost. And so now we want to record it at its net realizable value. And finally, 140 and 20 comes up with a net realizable value of 120. Well, that is greater than cost, and so we just record it at cost. So again, the balance sheet value is just going to look at the net realizable value versus the cost, and it's going to want to take the minimum of those two items, right? The lower of those two. Not really tough. The LCM rule can be applied directly to each item, as I did above, looking at number 1, number 2, number 3. We could total the inventory, and we could just say, all right, add up all of these estimated selling prices, 120, 120, 240, 350, and 490. Total up the cost to sell. Have a total net realizable value of 445. And then compare that to the total cost, which would be 395. And then we could just record the entire inventory then at 395 because that would be the lower of the cost or the net realizable value. Notice that when we do this, you're probably going to have a tendency to write down fewer items in your inventory, or less chance of less chance of an overall write down overall. Right? The application of using individual items produces the lowest inventory value. That is, going through and totaling each up by themselves and looking at each one individually. And it also provides a tax write-off with a loss. So, when you're thinking about these things, again, you start to want to think of the tax angle of these items as well as the financial book value. The total inventory application is going to produce the higher inventory values than it would if I looked at each of these under an individual basis. We could also group items, say look at 1 and 2 together, 3 and 4 together, and that's just going to give me something in between the two methods where I look at each one individually or I look at all 4 of them at once. When we write something down under US GAAP, that is the new cost of the item. Just as we saw with impairment, after a write-down, the new written down value in the case of, for example, number 3, so now we just assume the cost is $90 and go forward from there. We don't allow a write-up under US GAAP. However, IFRS does allow a write-up from a previous impairment of the value. So you can think of this whole process as impairing inventory. In order to record this, we have 2 methods. We have a direct method, which shows the inventory at market in both the balance sheet and the cost of goods sold. The market decline lost is going to be buried in cost of goods sold because we're just going to write it off directly to cost of goods sold. We're not going to have a different inventory item or a different loss specified for the write down in inventory. Under the allowance method, we're going to debit a loss to inventory, and credit an allowance account. Does not distort the cost of goods sold and clearly displays the loss from market decline. So I'm going to show you both methods, and we're going to look at what it would look like under both perpetual and periodic methods. So if we apply the direct method, if we do not separately recognize COGS, this is how we would do it. I'm sorry, do not separately realize the loss from COGS. So no separate loss account. And inventory is reduced directly. So the scenario I have here is that we had inventory at January 1st and then inventory at December 31st. We have some purchases, and then we have the December 31st marked at both cost and market. Notice that the market price of the inventory declined, and so I'm going to have a loss. This indicates a loss on inventory, but the way I'm going to represent it in my journal entries will vary from scenario to scenario. Under the perpetual method, using the direct method, I know it's a lot of different methods to sort of scheme out here. Perpetual method, in COGS, we would have a $2,000 debit, and then we would credit inventory for $2,000. Hence, the loss on inventory is going to be buried in cost of goods sold, and I reduce the inventory account directly. Under the periodic method, I would use my periodic journal entry, and notice that I just state inventory at the lower value. So I am still directly valuing that inventory at a lesser value. And I would follow through the periodic method with the same journal entries. I would credit beginning inventory to close it out for what it started out with, zero it out, reestablish it at its ending value, close the purchases account, and then cost of goods sold would be the plug for this equation, coming out to $2,007. Notice again, the decline in value of my inventory is buried in this cost of goods sold because the cost of good that I sold, if I look at just the cost value, was $2,005. But since I have an inventory markdown, I am sort of overstating my cost of goods sold. So if there is a loss on inventory value, COGS is overstated by the direct method. Now, that's not to say that income is overstated or understated, because income will still be reduced by the same amount. However, there's a distortion because I'm putting that loss into cost of goods sold. Let's look at the differences when we do it under the perpetual method with the indirect method. Under the indirect method, I would debit loss on inventory write-down, so I have a specific expense rather than just putting it into COGS. And I have an allowance for inventory account, which would be a contra account to my inventory, which would reduce my inventory without actually directly reducing the inventory account itself. Right? It's a contra inventory account. Looking at it under the periodic method, we would just write down the inventory the same as before. We have the loss and the allowance being credited for the same amount. And then I'd close out using the periodic adjusting entry where I credit my beginning inventory amount, debit my ending inventory amount, close out purchases, and record COGS as my plug. So notice here, COGS is only stated at $2,005 because I'm not burying that $2,000 into its value. So the advantages of using the LCM rule are conservatism. The disadvantages of it is that it does have an asymmetric treatment between write-downs and write-ups, but that's true for any impairment. Losses are recognized when inventory values decrease, but increases are delayed until the inventory is actually sold. So for example, if I have a market upswing, I don't write the cost up to the market, but I get to sell it at a higher price, and therefore I'm recognizing the increased market value. I'm just waiting until the sale. So again, this is in line with conservatism. Losses recognized early. While gains are deferred until sale. In this case, until sale. Right? And it can be somewhat inconsistent because one year I might have inventory recorded at cost, and then if the market falls, I would have to adjust it down to market. Inventory errors aren't something that isn't a totally new topic. It's taking an old topic we talked about, i.e. errors, and applying it to the inventory account. When you're talking about inventory, it's important to determine where the error occurred. Is it because it was counted incorrectly or because it was recorded incorrectly? So if we count it incorrectly, this is going to end up in ending inventory. And if we record it incorrectly, this is going to end up in purchases. Using the inventory formula will help you out in determining how these different errors will affect the overall balance sheet and net income. So let's look at a company, ABC, purchase goods on credit. So make sure you remember we're using an account payable. You have to be real careful about looking at the details of these problems, understand whether you're using cash or something else. For FOB destination, the purchase was recorded on December 28th, at which time the goods were shipped. They arrive on January 3rd. Assume they use the periodic method and that we're accounting for inventory on December 31st of the year end. So this is when we are closing the books and reporting. So this is when we're going to decide whether or not we made an error. So if I recorded a purchase and they haven't arrived, it's the end of the month, December, their FOB destination. Because their FOB destination, I should not have recorded that purchase. Using the inventory equation, I can now sort of map out how this error worked. There was no effect to beginning inventory, so that is still the same. Purchases were overstated because they should not have been recorded. These two are added together, and so that's going to create an overstatement, so you don't think that's a zero. That's going to overstate my goods available for sale. Now, my ending inventory, is that overstated, understated, or not affected? Because we would not count the inventory, remember we're using the periodic method, and we establish ending inventory by a physical count. Because the goods are not there at December 31st, we wouldn't put them in our count. They would just be overstated in the purchases account, and so there would be no effect here. Well, if something is overstated and I subtract off a number that has no overstatement or understatement, then I'm going to have an overstated cost of goods sold. Looking at the accounts that I'm asking you to report for, revenues are not overstated or understated. Expenses are overstated. Net income is going to be understated if expenses are overstated. Assets come from your ending inventory effect, so there's no effect there. Liabilities will be overstated because we're using credit. So the idea is that what we recorded was purchases and an account payable for those purchases. We shouldn't record this account payable or those purchases until they arrive on January 3rd. And so for now, my liabilities are overstated. And then if net income is understated, that would close to retained earnings and result in equity that is understated. Okay. Suppose D consigned goods to ABC on December 15th, at which time ABC recorded a purchase. Should they have done that? No. Because they are simply they are a consignor, or I'm sorry, they're the consignee. They should not record the purchase. The goods are still on ABC's premises on December 31st and were included in the inventory account. Again, should not be included because that means they would be reporting it as their inventory. So they recorded a purchase, which was inappropriate, and they recorded ending inventory, which is inappropriate. Let's put this back into my equation so I can see how this works. My beginning inventory, once again, there's no effect to it. The purchases are overstated because I recorded a purchase when I shouldn't have. Adding those together results in overstated goods available for sale because I'm adding them. And now I have an ending inventory that is overstated, and it's going to be overstated for the same amount as the purchase. Because these are both overstated at the same amount, if I take something that's overstated and subtract something that is overstated by the same amount, I end up with no effect because the errors will wash out, right? Think of it this way. If I have a true value for my gas, X, I have a true value for my ending inventory, Y, and they're both overstated by, let's say, $2. When I subtract these two items, I just get X minus Y because the $2 will cancel each other out. So there's no longer this error. I'm just left with the true value X minus the true value Y. So my revenues have no effect. My expenses are not affected because the only expense it would affect is cost of goods sold. Therefore, my net income has no effect, no error. Assets are going to be overstated, and liabilities will be overstated because the liability account, accounts payable, should not have been recorded. And then equity has no effect because there was no effect to net income. One more example. On December 30th, ABC sold goods to D Corporation on credit FOB destination. The sale was recorded on December 30th, at which time the goods were shipped. They arrive at D Corporation's place of business on January 2nd. Should ABC have recorded that? No. They shouldn't record the sale. And now also notice we're talking about ABC in this case, not D. ABC sold the items. They should not have recorded the sale until January 2nd. So now we have, again, looking at ABC, the other thing we have to think about with ABC is they're selling these goods and they're recording that sale. So if they're selling them on credit, what they recorded was AR and sales revenue. So this one is a slightly different perspective because we're not just looking at the purchaser side, we're looking at the buyer side as well. So beginning inventory for ABC has no effect. Purchases, we didn't talk about any purchases, so that also has no effect. They have no effect to their overall gaffs. Their ending inventory, because if they make their ending inventory is not going to include those items, right? They're going to make a physical count of these items, and they're not going to have them on their premises because they already shipped them on December 30th. And so they're going to have an understated ending inventory because those goods should be included in their ending inventory. If we have something that has no effect and we subtract something that is understated, then we are going to have an overstated costs of goods sold. If we recorded this when we shouldn't have, right? This increased an asset, this increased my net income. In this case, I'm going to have overstated assets, and I'm going to have overstated net income. Now, the question becomes, because I have multiple effects going on, right? I have an overstatement in assets from the accounts receivable, but I have an understatement of assets because of my ending inventory. And I have an overstatement of net income because of the sales revenue, and I have an overstated cost of goods sold thanks to the effect of subtracting off an understated ending inventory. So were my revenues overstated or understated? Well, revenues were overstated and expenses were overstated. Now, what happened to net income, right? What is the balance? Well, if these were both overstated by the same amount, there would be no effect. But were they? Notice that the sales prices are 30% markup over the cost. Right? They're selling for more than their cost, which any company would do if they want to stay in business. And that's going to mean that this revenue error is greater than the cost of goods sold error. So net income will be overstated. Similarly, even though I've understated my ending inventory, the overstatement of my sale will counterbalance that and still make an overall overstatement in assets because once again, we are selling things at a 30% markup over their cost. Liabilities have no effect, and equity will be overstated because net income will be close to it. All right, so that concludes the inventory chapter and everything that I'm going to actually test you on. I know it's a lot of good stuff, so make sure that you absorb this stuff along with everything else and put it to work and think about it all together.